Hello, my name is Scott Forehand. I'm agency director here at Symmetry Financial Group, and I'm here today to talk to you guys about debt-free life. And so just so we're on the same page, what is debt-free life? Debt-free life is actually a play on words. It is using debt to get out of debt, and having a debt-free life is the goal. And the program that we have here, the proprietary program here at Symmetry, uses a number of different methodologies to get you to that debt-free life living. But let's focus for just a second on why we're doing this. What is the reason why we're trying to get rid of debt? And you don't need any more reason than to take a look at this. That's the US debt clock. The last time I looked at this, which was about 3 or 4 weeks ago, we were at 27 trillion in debt. We've grown $261 billion in debt. And that's because we all know our federal government cannot stop spending money. And they keep coming up with more reasons to spend more and more money. And certainly COVID hasn't helped. But the reality is we are unfortunately now spending our grandchildren's retirement. And not ours, but our grandchildren's. And that's about how long this is going to take. And that should drive home a couple more things for you to say, which is, or think, because we're going to get to this a little bit later on. But a critical thing to be aware of is the US government and Medicare and Social Security, both of which are going to become insolvent within the next 15 years, unless they do something. And they're certainly not going to be able to let them become insolvent, so they're going to have to fix it. And the way they're going to fix it is they're going to go up on tax, which means for all of us that pay taxes, your taxes are going up. So debt-free life is a way that we can help address some of those issues now before it happens, before we get too far down that path. So let's go ahead and get started. Back to debt-free life. What is debt-free life? Again, it's a play on words. One of the key things we think about is over time, we're going to pay a tremendous amount of money in taxes. This certainly was not what our founding fathers had in mind. That's the whole reason why the Boston Tea Party happened. And they were at somewhere between a 3 and a 6% tax rate now. We're looking at for the wealthiest people in this country as much as a 50 or 55% tax rate. And for the middle America, we're still looking at somewhere between 30 and 40%. There's got to be a better way. And so that's what debt-free life is about, one of the things. So the first two questions we ask, or you should be asked, is, are you 100% certain you're going to have a great retirement? And I don't know anybody that can say that. And I certainly can't, although now that I've got my own debt-free life program running, I know that we are going to have a fantastic retirement. But I don't know anybody without a DFL program that can say that. And the second question that we ask is, most of the time, people that we run into in the nature of our business have a mortgage. And if we could show you a way to pay your 30-year, your 25-year, your 20-year mortgage off in less than 9 years, probably would you be wanting to listen to us? And the critical components of that are, we're going to do that without you spending any more money than you're spending right now. We're not talking about going and getting a job. We're not talking about eating tuna fish and ramen for the rest of your life. We're just talking about spending money the way, a different way than you're accustomed to spending, but spending the same amount of money. Okay. So let's move forward. So if you're like me, before I started my debt-free life program, this was the average household. I was the average household. I spent 23% of my money on my lifestyle. 3% of my money went into savings. 34% of my money paid interest on all the debts that I had. And 40% of my money paid taxes. Let's put that in perspective. That means 74 cents out of every dollar was paying for taxes and interest. 74, almost 3/4 of my effort was being given to somebody else. And I was trying to make ends meet on 3% of savings for the future, and 23% of my money. That's my lifestyle money. What is that really? That's not lifestyle. That's paying my car payment. That's paying the power bill, the water bill. That's paying my mortgage. That's putting food on the table. If there's anything left, that's my lifestyle. Maybe I've got some money left over for my Hulu bill or my Netflix bill. This is not the way our founding fathers had. This is not what they had in mind. And if anybody has any illusions that you're going to be able to maintain an income level similar to what you're doing right now, and a lifestyle similar to what you're doing now when you retire, if you're saving only 3%, and maybe you're getting a 3% match from your employer, that means you're planning on being able to exist on 6% of what you make right now. So think about that for a second. It's not tenable. It's not going to work. And if they don't rescue Social Security, it is going to be your only source of income. Or maybe they're going to start doing it and they're going to start gauging that, well, you saved, you've got a lot of money for retirement, so you're good to go. You don't need your Social Security income. That's one of those other plans that's on Capitol Hill right now. That's scary. So what can we do? Well, we can fix it. How do we fix it? First off, you have to observe where you are. You have to realize what's going on. The average American's making 65, by the time they turn age 65, has made $2 million in their lifetime. That's a lot of money. It's plenty of money. It's plenty of money to live on if you spend it right. But most Americans don't. And that's that 3% number, the funds at retirement, $60,000. That's what that represents. So they've made $2 million in their lifetime, but they've only saved $60,000 for retirement. How long do you think that's going to last? So just take a little accounting right now of yourself. How much do you make per year? Do you make $30,000 a year? That means you've got 2 years of income saved up. Is that enough? Do you think you're going to live longer than 2 years? Do you think you're going to live 5? Think you're going to live 20? This is one of the biggest questions most people have as they approach retirement. Is one of their biggest concerns is, am I going to have enough money for retirement? And what I would say to you is, if your method for saving for retirement has been doing the company 401k or 403 or any one of those retirement vehicles because they were a great idea, a great deal, because you don't have to pay tax on it now, I'd say, unfortunately for you, drank the Kool-Aid, and the Kool-Aid is not good. And the old illusion of whether a 401k is a great deal or not, it's unfortunately untrue. If you were ever told that you would pay money now into your 401k so that you didn't have to pay tax on it now to get you into a lower tax rate now, that was good when the tax rates were low, but the taxes are going up. So what's really going to happen is you're going to not pay some tax now so that you can pay an even higher tax rate later. You may be at a lower tax bracket, but the tax rate for that bracket is most likely going up, which means you're probably going to end up paying more tax later. And Uncle Sam thanks you for it, because that was the deal they made with you. They said, you know what? Let's do this. I'm going to make you my business partner. I'm going to allow you to save your money. And that's what Social Security is. I'm going to allow you to save your money, and you're going to give me the money, all the money. I'm going to keep all the money. And then at a later date, sometime in the future, and I'm not going to tell you when, but at sometime in the future, I'm going to allow you to start taking some of that money back. I'm not going to tell you how much interest I'm going to give you, and I'm not going to tell you how much money you're going to make from it. But I am going to tell you I'm going to tax you along the way. That's Uncle Sam's deal with you, and it's really not fair. So, looking at this from the future standpoint, what do you need to do? Well, you need to save a lot more than $60,000, because if your effort is going to be relying on the federal government, you're going to have an issue. So that question out there at the bottom, is this the American dream? It absolutely is not. So what do we do? Well, we really take a full observation of where we are right now. This is you, most likely. And if you go talk to someone about how to manage the debt that you have, and you have some probably, you got a home, got maybe a car, maybe a credit card, maybe a student loan. Student loans are evil, people. Maybe some personal loans. They're going to tell you, if you're talking to like a debt consolidator or someone who professes themselves to be a debt counselor, okay, they're going to tell you those bullet points on the right side of your screen. Work harder, spend less, save more, refinance. These don't make any sense. The working harder routine, you already work hard. How much harder can you work? How much of that extra time that you have are you going to sacrifice so you can make some more money? Spend less, okay, maybe, but is that tenable? Save more? Well, if you're not making more, it's hard to save more, right? Refinance. Why? I'm going to move the money over here, the debt, to create a debt over here. There's no difference. You might be changing the interest rate a little bit, but it doesn't make any sense. Consolidate, that's kind of the same thing as refinancing. It doesn't work. It doesn't work always. There's a reason why you got into the situation you're at right now, and there's a way to get out of it. And it's not any of those first 5 bullets. The only thing that they're going to tell you that's going to work on a regular basis, not all the time, but on a regular basis, is a debt snowball. But most of the time, what they're telling you to do is actually what's called debt stacking. And debt stacking definitely fails. There's always a better way, and debt stacking is usually not the better way. So what's the better way? Well, stay tuned. We'll get there in a second. So if we could tell you how to eliminate all your debt in 9 years or less, including your mortgage, without spending any more money, would you want to listen to us? And hopefully that's why you're here today. That's why you're watching this video. So where we want to get you to is where you probably are right now on the left side of your screen with the household average debt, $250,000. Actually, I see higher than that most of the time. Saving only 3% of your income for retirement, paying 34 cents on every dollar for interest, paying 40 cents on every dollar for taxes, and having that 23% left over to live your life, pay your bills, put food on the table, maybe go do something fun. That's where you are. We want to get you to the right side of the screen. I want to increase the amount of money you have left over at the end of every month by 43%. What does that mean? Think of it like this. If you have $1,000 left over in your checking account every month, okay, to start the next month with, right? What happens if we change that to $1,430? That's a 43% increase. What would you do with that extra 430 bucks? I don't know. Have fun, relax. Remember, we're not trying to make you go out. You're not getting a new job. You're not getting a second job. You're not spending less. You're not eating tuna fish and ramen. We're not doing any of that. We're just going to show you a more efficient way to spend money. We're going to increase the amount of money you have left over every month by 43%. How do we do that? Well, see that taxes? The amount of tax you pay over time is about 40% of all the money you make. It's probably higher than that, but that's the number we're using for this illustration. We're going to get you to the point where you're going to save 10%. 40 minus 30 is 10, right? Nope. We're going to reduce that amount by 25%. That's a huge number, especially over time. So think about this. Think about how much money you pay on income tax right now, every year. If you make $100,000 a year, you're probably paying at least $40,000 in income taxes. If we could make it so that you didn't have to pay 40, but only had to pay 30, make that extra $10,000, what do you do with it? Whatever you want to do with it. My first suggestion would be you put it into your DFL program and sequester that money forever. We'll talk about that in a minute. Look at that interest. If I can reduce the amount of interest you pay over time from 34% to 22%, wouldn't you want to listen? Wouldn't you want to try it? So I can tell you, trying it and following the system that we're going to show you, you will have the result that we see on the screen. But there's one more thing we got to focus on. That savings column, that savings piece of the pie. That's the most important thing here, because the debt-free life, if you use it correctly, it does a couple of different things, but primarily the biggest thing it does is it creates a massive tax-free retirement available for you at the end of the run. And I'm not talking about waiting until you can take Social Security, 62. I'm not talking about that. You get to start your retirement whenever you want to, not when the IRS dictates. And once you start the program, it becomes a juggernaut, which is how I can have you spending more money every month comfortably, spending less on interest, less on tax, and saving from 3% to 15% to 12% increase, right? No, that's a 500% increase in the amount of money you're going to have for retirement. So remember that slide before where we had the average American made $2 million and they had $60,000 left over at the end that they'd save for retirement. If you're the average American, I'm going to make that $300,000 using a debt-free life program. Let's move on. So how do we do it? all those things. We address all the issues, all the places where you're spending money inefficiently. We're going to reduce the interest that you pay. We're going to reduce the taxes that you pay. We're going to eliminate your debt as quickly as possible, more quickly than you ever thought possible. I'm going to improve your cash flow so that it doesn't feel like it's tight. And I'm going to allow you to retire with what we call a tax favored income. It's tax exempt if you play it right. So this is actually not new. This particular program, Debt Free Life, is new. This became available in May of 2019. It is a Symmetry Financial Group proprietary product, and it's a proprietary solution. And one of the things that we did when we looked at all the other solutions that were out there, I'm not going to say their names because I don't want to advertise for them, but all of them have an Achilles heel. There's some reason why each one of them will fail on a regular basis. And I don't want to point you in that direction, but one of the most common reasons that they would fail is because they would assume that you're never going to have an emergency. They would assume that you're always going to be able to work. They would assume that you're never going to die. They would assume that you're never going to have to put a new roof on your house or a new transmission in your car. They did not plan for the unexpected or the emergency. And that's a key difference from our system. We did. We took all those contingencies into consideration and we put a plan in place for it to make it happen. How do we do it? Well, the money that builds up in these programs, the part that you can see, it's about 80% of what's actually there. And we do that on purpose. That's because we want that remaining 20%. When you have to put that new roof on your house, or you need to put that new transmission in your car, we want the money to be there when you need it. And we don't want you to have easy access to it. And we want it to be painful for you to pull it out. So it's there, it's for you, it's for an emergency, and it's helping your system grow, your plan grow. But we don't want you to have that, I need to buy a new jet ski emergency, or I need to go to Tahiti emergency. We want it to be a real emergency and make it painful for you to get to it. Rest assured it's there, it's working for you, you just can't see it. Okay. So what we did by incorporating that 20% emergency fund into our system is why most the top 10 programs that are out there, why they all fail. It's because they don't plan for the emergency. And we've taken that out of the mix. So how does this program work versus what you've already heard of? A Roth, a 401k, traditional IRA. How does this work? Hands down, the others cannot compare with this. Assuming we have a $10,000 investment in the tax-free solution, which is debt-free life, the tax-deferred solution, which would be a Roth or a traditional IRA, or a traditional tax solution, which means you're putting your money in a savings account. If you look at the same investment across those three different scenarios for the same amount of time, which is 28 years, using the same amount of average interest, which is 7%, assuming you're at the same tax rate across the board, the end result, it's not disputable. The end result is you're going to have a significantly larger amount of money left over after that 28-year run in a tax-free system. Why? If you put the money into a tax-deferred system like a 401 or even a Roth to a lesser degree, there's going to be an income, there's going to be a time to pay the tax. You're going to have to pay tax on some of that money. And if you're deferring the tax, then the amount that you owe on a tax, it's growing too. It's that simple. So if I'm letting my money grow in a tax deferred account, like a traditional IRA, and I'm taking the money out later, when I take the money out later, if I owed $5,000 in the beginning and it's grown 10 times, now I owe $50,000 in tax. The tax grows at the same rate. Okay, so the point that we're making here is there's no comparison. It is hands down paying the tax up front and putting it into a tax exempt solution, tax free. You can't compare the 401. The only time you're going to see a better result with a 401 is if you're getting a match from your employer that's significantly higher than your contribution. If it's a 1-to-1 match, it's not going to win. If it's a 2-to-1 match, like you put in $1 and they put in 2, that might win, but not on a 1-to-1 match. So let's move on. This, like any other financial instrument, is going to have different phases of how you utilize the program. So traditionally, we're looking at three standard phases for a debt-free life program: maximization, accumulation, and distribution. So let's talk about maximization for a minute. Maximization, what that means is we're getting you to the point where your money's working for you faster. Okay, so you have X amount of debt right now. If I can get that so that in 9 years you have 0 debt without making any more money, without spending any more money, then in 9 years you'll be able to greatly increase the rate at which your retirement can grow. Okay, so the idea is we want to start the maximization phase immediately. We want to ramp it up as quickly as we can. And we want to get out of it as quickly as we can. Out of the maximization phase means we're done with the debt, whatever the debt is: house, car, student loans, credit cards, personal loans, whatever it is, medical bills, doesn't matter. We want to get all of it gone. Let me say this. There's a misconception sometimes that what this is a debt consolidation. I already talked about that. This is not debt consolidation. This is also not us calling up your lenders and saying, hey, I know we owe $3,000. If I give you $2,000 right now, can we call it even? That's debt negotiation. That's not what this is. We're not going to get you out of paying your debt. You have the debt, you're going to pay the debt. It's okay. And in the end, you're going to have more money than you ever thought possible. And more importantly, or even less importantly at that point, your credit score is going to shoot through the roof. We don't care about credit anymore when you get to that point because you don't need credit anymore. You're going to become your own bank. So that's where we get into that accumulation part. So let's assume we've progressed through the maximization phase. We've paid off all of our debts and we're cycling through that money. We're doing what we call dollar cycling. We'll get to that in a minute too. And we're into the accumulation phase. Now, all that money that we're putting into our program is working and working and working for us. All that money is compounding. All that money is creating a massive retirement. And because we paid tax on it in the beginning, it's not taxed when we pull the money. And there's one other reason too. We'll talk about that in a minute too. So now we get to the accumulation phase. And in the accumulation phase, we're growing money at a faster rate than you've thought possible. Why? Let's compare that. So if I put money into a 401k, I never gain or lose money in a 401k until I pull the money out. Okay. So if I have a 10% gain 1 year and a 5% loss the next year, and then a 5% loss the third year because the market went down, which does anybody remember 2008? Does anybody remember the early 1980s? Yeah, this is not abnormal. This happens frequently, unfortunately, usually multiple times in our lives. You have 2 years back to back, it can wipe out all of your gain in a 401 or a 403 or any other retirement program where your money's invested in the market. Our money in this program is not invested in the market. So where you may have a 10% gain in 1 year, in our program, we're going to get a guaranteed 4%. Okay, so 10% is better than 4. I give you that. And then in year 2, we get a 5% drop. So now we're at plus 5% in a 401, and we're now at plus 8% in this program. And then in year 3, we have another loss, down 5 more percent. Now we're back to 0. And where this program is, we're now at plus 12. That's before the dividend. That's before any additions. That's before the compounding. So that's a key difference. And that's why the accumulation phase is really important. We want to get you to that point where you're having the massive growth. And then finally, we get to the point where we're at the distribution phase. And this is where you can go buy that emergency jet ski. You can go take that emergency trip to Tahiti. You can do whatever you want to do with it. It's your money. More importantly, the IRS can't tax you when you take it. The IRS can't prohibit you from taking it too soon. The IRS can't penalize you if you take it too soon, because there is no too soon. And the IRS can't force you to take it and force tax upon you if you take it too late. This completely ignores the IRS's control because this is not an investment in a traditional sense of the word. This is a life insurance program. And because of that, we are taking advantage of IRS tax code 7702, which says all monies derived from a life insurance policy are tax exempt. So whether we're taking cash out, that's our cash, or whether we're taking a loan out, which is still our cash, there's no tax. So that's how the non-tax event works. Let's move on. As I mentioned, this is not a new program. This has been around for a long time. This uses a concept called infinite banking. And everybody you see on your screen right there, they've all used or are currently still using the concept of infinite banking. Berkshire Hathaway, Warren Buffett, he still does it to this day. Walt Disney did it when he started all the Disney properties. Ray Kroc did it when he did his first 12 McDonald's units. And Doris Christopher did it when she started her program, The Pampered Chef. So this is not abnormal. This is not new. The wealthiest people in the country have been doing this for ages. The problem is it wasn't available to most of us because you had to have a very large sum of money to be able to start one of these programs. Let's move on. Now we're getting fun. Okay, so how are we going to do this? And I just mentioned this a second ago. We're going to harness the power of life insurance. We're going to use the benefits afforded to life insurance programs as afforded by the IRS tax code. The cash growth that we're going to have in this program is going to grow inside our policy. And when we pull the money from our policy, it's either going to be life insurance, tax exempt, or it's going to be a loan, tax exempt. So all the money you're pulling out of the policy, when you pull it out, it's all tax exempt. We're going to pay off your debt in 9 years. We talked about that a few minutes ago. That's that maximization phase. We want to get you through that as quickly as possible so we can get to the accumulation phase where you're building that massive retirement. Okay, so now you ask, well, wait a minute, you're going to take loans. Yeah, we're going to take a loan. Okay, so that means I have to pay it back, right? Well, maybe. What do you mean maybe? Well, yeah, maybe. Why? Well, because it's a loan against something that you own. A private bank, if you will, okay? Who's the banker? You are. So you make the determination, do you want to pay yourself back? Because that's what this is. This is infinite banking. I'm using my bank. I'm creating a personal bank, which is in the form of a life insurance vehicle. I'm going to borrow money from myself. Do I want to pay me back? Maybe. There's logical reasons why you would want to and logical reasons why you wouldn't. It doesn't, it's every case is individual and unique. So do I have to pay my loan back? Yes. When? Doesn't matter. Your loan is using life insurance as collateral. So if you do not pay your loan back, if there's a loan left at the end when you pass, your life insurance is going to pay the loan off. Well, what happens if I want to pay it sooner? Pay it sooner. Okay. Whatever, it's up to you. You control the program. You own the program. You own the bank. You are the bank, okay? Well, what happens if there's lots of what happens is. We can go there all day long. We don't need to. I'm just gonna let you know, you can pay the loan off if you want to. You don't have to. It'll pay itself off eventually when you pass, and that's a kicker here. These programs, when we structure them, they come with, we use a specialized type of corporation called a mutual corporation, which means when you take out one of these policies, you become a member of the mutual corporation, and essentially you become eligible for stock dividends. So not only do these programs pay a guaranteed interest rate, they also pay a dividend. And when I said you don't have to pay the loan back, why? Because the dividends over time will pay the loan off for you. Yep, get that one through. Pretty cool, right? All right. So legacies. So we talk about leaving a legacy, and that's usually a conversation we have with life insurance. This program leaves a legacy in spades. What I mean, it's not just, I want to pass some money on to my son or daughter. If you structure these programs correctly and you utilize them correctly, this can create generational wealth. Okay. Yeah, I don't mean one generation. I'm talking about you could have this program fund the retirement of your daughter, your granddaughter, your great-granddaughter, grandson. It can do it all. It's pretty amazing. So where are we now? This is what we've tried to do. Over time, we're looking at the interest that we've eliminated. And that's really only one thing we look at. It's not only the interest, it's also the taxes. How much have we eliminated there? How quickly did we eliminate the debt? How quickly did we get your debt snowball, talk about that in a minute, your debt snowball to work for you, to become that juggernaut that you can't stop it. We're going to improve your cash flow. We're going to have you see that last bullet there, allow you to retire with a tax favored income. I don't know any income as far as taxation is concerned that's more tax favored than tax free. Tax free, zero is a hero, right? So those three families that you see over there, those were some of the first groups that we worked with when we started this program. The amount of debt and the amount of interest that we save for them is pretty significant. But when I've done a lot of these programs, and it's actually significantly higher than what you see on the screen there. So let's talk about how you spend money right now. And this is a key thing about how debt-free life works. We're going to change the way you spend money, right? I didn't say we're going to make more money. I didn't say we're going to spend more money. You're going to spend the same amount of money, but you're going to spend it in a more efficient way. So let's look at how you spend money right now, so we have a good level to compare to. So you go out and you work your job, whatever that is, 1099, W-2, W-4, whatever. Maybe you make royalties. I don't know. However you make your money and you deposit it into your checking account. Wells Fargo, Citibank, Bank of America, whoever you bank with, doesn't really matter. And so your money is then deposited into that checking account or that bank account or that savings account. And as a nicety, the bank will say, you know what, you've got enough money on deposit with us. We're not going to charge you to keep your money in our bank. Nice, right? What else do they do? Well, they lend your money out every night at the federal funds rate or higher. The average dollar you put into your bank account is spent 7 times by that bank. It's lent out 7 times before you ever do anything with the money. So let me ask you this. How much interest are they paying you on the money that's in your account? So if you happen to have a money market account, you might be making a little bit. If you don't, then the best thing you're probably getting from that bank is that little, we're not going to charge you to keep your account open with us. And they're not splitting the money with you. So let's move forward in time. Now you've had your money in there. It's been there for a week. The bank has lent it out 7 times. And they've made money with it 7 times. They haven't given you a dime. The only thing they've said is they're not going to charge you to keep your money in their account or in their bank. And now it comes time for you to pay your car payment. So you execute whatever you're going to do. You do use your bill pay, you write a paper check, mail it in, whatever. However you instruct your bank to pay your creditor. You tell them to pay the debt. And now all of a sudden, your money is now their money. Your money became their money, but it stopped over at your bank while your bank used it 7 times, made money with your money, and then went ahead and paid your debt. So where are you? You're at 0, right? You had $500 of your money go into your checking account. The bank used it, made money with it 7 times. You told the bank to make your $500 car payment, and now your money has become their money. It's gone forever. And if you're super sweet and super nice and ask really, really nicely, can I have my money back? Your creditor is going to say no. That money is gone forever. It is no longer your money. It is their money. This is how you spend money today. This is an inefficient way to spend money because you are not letting your money work for you. You are working for your money. You're not letting the bank help you. You're working so the bank can make money. It's not fair. So what's a better way to do it? Here's a better way. This is the debt-free life method. So you do your job, whatever it is. You make the same money. You do the same thing. You deposit that money, that income, you deposit it into your checking account. Whoever you check with, bank with, doesn't matter. Okay? But here's where the rubber meets the road with the debt-free life method. We're going to stop for a second. And before that money, or maybe not, but at some point you're going to write a check to your life insurance company. And you're going to write a check that's going to come out of your checking account, which means the money's leaving your checking account. And you're going to send it to that life insurance company. You're going to pay a premium payment on your whole life policy. Okay. So your whole life policy, doesn't matter what the size is, it's irrelevant. We're not doing this for the amount of death benefit. We're doing this because we're creating a private bank. Make sure we understand that. So I'm going to make my single one premium payment to my whole life policy. Now that whole life policy, because of the way we structure these and in order to take advantage of the tax code, has two very important riders. The first one you probably heard of, it's called a term life rider. What does that term life rider do? What it does is it maximizes the size of life insurance of the policy in the very beginning. And that's a critical thing because when we're going to throw cash at this and stash cash in there and use this like a private bank, we cannot have the amount of cash exceed the amount of life insurance. If we do, then this program will become what we call a modified endowment contract, a MEC. And if this program becomes a MEC, the game's over. Everything is taxable. It's no longer considered life insurance in the eyes of the IRS. It is then a modified endowment contract, and an endowment contract becomes taxable. So that defeats one of the main purposes why we're doing this. So we don't want it to MEC. That's why we have that big term life umbrella. Because as long as that big term life umbrella, the term life rider umbrella is sitting there, and the IRS cannot see what we're doing underneath it. All the IRS does, they come by and say, oh, you got $100,000 of life insurance? You got $90,000 cash in here? Okay, you got more life insurance and cash here. Good to go. Okay? So that is a critical component of this. But here's where your bank really starts. It's the paid up edition. So let's talk about that for a second. What is a paid up edition? It's more life insurance. That's all it is. But the name is significant. Paid up edition. It's paid up additional life insurance, meaning you make the payment one time, and then you've got that amount of coverage for the rest of your life. It's additional life insurance that's paid up. You never have to pay for it again. So if you have $1,000 in your hand, it's worth $1,000. Tomorrow, it's going to be worth $1,000. 10 years from now, it's worth $1,000. When you die, if you haven't spent it, it's still worth $1,000. It's an asset. It's an asset with zero cost to maintain. So if you talk to the largest banks in the country, Wells Fargo, Citibank, Chase, these guys, if you talk to them and ask them, what do they consider a good asset or a strong asset, a safe asset? They'll say, well, assets come in four classes, tier 1 through 4. We consider this a tier 1 asset. A life insurance policy that's paid up is considered a tier 1 asset, tier 1 being the best. Why? It has permanent value that will never degrade. It does not cost anything to maintain. So that's why there's all these companies out there called viatical settlement companies. All they do is go try to buy up people's life insurance policies, especially ones that are paid up. They pay them pennies on the dollar because they know as soon as that person dies, that policy is worth all that money. So what did we do? Let's circle back. In our checking account, we wrote a check to our life insurance policy. That life insurance policy was a single premium. It hit the carrier and got split into 3 parts. Whole life, which is the core policy, term life, which is that big umbrella, paid up additions, which is essentially an asset, a tier 1 asset, an investment, okay? Here's where the magic is. That term life rider costs us 10, 11% of whatever your premium is. The whole life, remember I told you there's a hidden emergency fund we talked about earlier, right? That whole life, because all whole life policies have the ability and capacity to grow cash value, about 21% of that premium that you mailed, that you sent in, is going to whole life. About half is going to cash within that whole life. So you got 11% going to term, 10% going to whole life, another roughly 10, 11% going to cash value. That means 68% of your premium payment is going to paid up additions. That means every time you write a check, you're buying 68%, 65, just depends on how it's structured when you take the program out. 68, 65%, whatever it is, goes to purchase a tier one asset that has permanent value. Okay? Remember I said earlier, in an emergency, you can take the cash out. That's the cash that's in your whole life. That's that 20% emergency fund. The paid up addition, that's the money you borrow against. Okay. So if I have $1,000 in paid up additions, is the carrier going to worry if they lend me $900? They're not. Why? Because they've got $1,000 of collateral. That's how the program works. You're going to borrow money from yourself and spend it. So let's move forward a little bit. So now that you've made that payment, a single payment up into your debt-free life bank, remember that circle? That circle where the bank was using your money over and over and over again? They were dollar cycling. We're now dollar cycling. We're using our own money. We're earning an interest rate on it, right? Remember that? The guaranteed interest rate for these programs is at least 4%. In addition, that pays a dividend every year based on how much money. There's 16 factors that determine how large your dividend payment is. And in the first couple of years, it's tiny, so you don't really worry about it, but it gets to be massive. Okay. So we are now using our dollar over and over and over again. And depending on the carrier that you use, some carriers do compounding annually. And at least one carrier that I know of does monthly compounding. And that's a huge deal. So I'm earning money with my money every month, right? So now I've got, instead of the bank earning money with my money, I've now moved my money up into my private bank, which is my life insurance policy. And I'm making money with my money every month. And now all of a sudden, that $500 car payment comes due. What do? You call the carrier, say, hey, send $500 to my bank account. Wells Fargo, Chase, Bank of America, whoever you bank with, it doesn't really matter. Send $500 to my bank account. So now you've pulled a loan of $500 out of your DFL bank, a loan. You've deposited it into your checking account. Great. And now you tell your bank to go ahead and pay your debt. Mr. Bank, go ahead and pay my GM car loan, please. Send them $500. I just deposited $500 in my checking account. There should be the money there. Okay, they make the payment. Then what do? Well, GM receives their car payment and they're happy. Their debt has been paid. They're happy for now until next month. Where's your money? Your money is still sitting in your private bank, your DFL bank. You did not use your money. You did not pull your money from the bank. This isn't an emergency. You took a loan against the paid up addition value of your bank. And if you never pay that loan back, it's okay because there's enough collateral in there to pay it off when you pass. And if you have a lot of money in there and you have this program running for a while, you're going to receive a dividend every year. That dividend is going to pay that loan back for you automatically over time. So when you ask me, do you have to pay your loan back? Yes. When? Don't know. You can let the program pay it back for you. You can pay it back yourself. You can pass and you'll pay it off then. And don't forget, even though we're buying all this paid up additional life insurance, the whole life in that term life, that's still life insurance. So even if you pass with a massive loan against most of your paid up additions, you've still got that term and whole life piece that's going to pay off anything else that's out there. So you're covering your family. You're creating a legacy. All right. So let's move forward. Let's see how this works in real life. So this is a family that I worked with a couple years ago. This is Halloween 2019. This family, nice folks. They were had both been previously married before. The gentleman was younger. He was in his mid-30s at the time that we did this. The wife was a little bit older, but she was also she was a doctoral student, getting her doctorate. And so she had a tremendous amount of student loans. They had two properties. One was her primary residence and one was a rental property they had from previous. And they had a lot of other issues. The gentleman works as a 1099, so there were some tax issues that were laying out there. They had taken some loans out. They had a couple of credit cards. They had nice cars. And when we looked at their debt load, it was going to take them about 40 years to get out of debt. That's a long time. The reason why is because of that student loan. Did I mention that student loans are evil? And then, so the student loan debt is really what took them out to that 40-year time frame when they were going to be debt free. And then when we looked at them and showed them what their actual debt was, it wasn't $585,000. That's the principal amount of their debt. When you looked at how much interest they were going to pay over time, it's astronomical. They were going to pay almost an additional 30% of what they owed just as interest. So when we looked at their true debt, not $584,000, if they had a checking account with $585,000, they could have paid their debt off in one day, but they didn't. They had everything financed. So it was going to take them 40 years to get out of debt. And at the end, they would have paid back $767,000. There's a better way to do this. And here's the better way. When we ran these numbers for them, remember I talked earlier about debt stacking versus debt snowballing? Here's a perfect example of why debt stacking, which is what most people think of, is not the best way. If we look at these debts that they have, the first thing they paid off was a medical bill, even though it was at a 0% interest. And the reason why is because it created the debt snowball the soonest. The idea is that when we've got the infinite bank part, we've already talked about that. We understand what that is and how it works. It's a life insurance policy, that's all. But when we couple that with a financial strategy of debt elimination using debt snowballing, then our goal is to create the largest snowball the fastest. And it doesn't mean we're going to pay off the highest interest rate thing first. In this scenario, the highest interest rate thing that they had is being paid off in the fourth position. Okay, so that's debt stacking. Debt stacking says pay your highest interest rate off first and then move on. That's not the best way. 99 times out of 100, it is not the best way. A true debt snowball is the best way, and that's what we use here. So we took them from 40 years of payoff down to 7.8 years. This is 2 years ago. So they're 2 years into their program at this point. They've got about 5.8 years left. We saved them $70,000 of interest. That's a lot of money. I'll take $70,000. If you want to send me some, let me know, send me an email or whatever. I'll give you my address. You can mail me a check, okay? But more importantly, it's what did it do? So if you think about where they were in 40 years, they were going to be debt-free, right? 40 years, have 100% equity in 2 houses, and be debt-free. And that's it. What this program did for them is it allowed them to supersize their retirement. So that was where they were, 40 years, $182,000 of scheduled interest. We eliminated 32.2 years of payments. Huge. Saved them $70,000 of interest. Huge. But here's the kicker. At the end of 40 years, where they were before, out of debt, 100% equity in 2 houses. Where they are in our program in the same 40 years, they're out of debt, 100% equity in 2 houses, and $4.8 million liquid cash sitting in their program. How? Einstein said it. There's nothing more powerful than the effect of compound interest. And if you've got a compound interest program like this, that's tax exempt, that doesn't care whether the market goes up, down, or sideways because we're compounding our interest every year, 4%, 4%, 4%, 4%, plus a dividend, you can't lose. One more thing down here. This also came with, remember, life insurance. So not only did it come with, at the end, $4.8 million in cash, it also came with $1.1 million of life insurance that at the time, in 40 years, would be fully paid up. Did they create a legacy for their family? Did they make the right decision? Of course they did. This is a no-brainer. All right, so let's see, how did it work? So each one of these yellow bars that you see is a year where they pay off some debt. In many years, they're paying off multiple debts, okay? So in this scenario, in the first year, they took $14,900 loan from their private bank, which means they paid off $14,915 of debt. At the end of the year, just through the process of dollar cycling, they had paid off about $6,000 of the 14 that they borrowed, 14.9 that they borrowed. Okay. Not only had they paid off that $6,000 because there's only $8,000 in debt left over, they also had $12,000 sitting in their account at the end of the year. Some of that, see this, E&E, that's the emergency fund. That's the cash value of their whole life. Some of it is still sitting in their cash value, and some of it is still sitting in the cash value of the program, which is the paid up addition piece. But at the end, it's $12,000. So they borrowed $14,900 from themselves, paid back $6,300 to themselves, and at the end of the year, they still have $12,200 left over in their program. Sign me up, okay? Year two, it got exciting, because remember, year two, now you got compounding kicking in, right? Year two, they borrowed $15,000. They paid off the $8,000 that they owed the year before, plus paid off $8,000 more from this year because they're down to $7,700 loan value. And at the end, they still have $33,000 sitting in their account, $7,100 sitting in that emergency fund for a combined amount of $40,000. That's how the program works. It uses the debt snowball, the money you were spending inefficiently, to spend money more efficiently, to put it into a program where you can sequester the money permanently, make the money work for you permanently, pay your debts off quickly, eliminate the interest quickly, and then by default, over time, eliminate the taxes that you're going to pay later on, because you're not going to be using this as a taxable retirement fund. It's going to be used as a tax-exempt retirement program. Look at year four. In year four, there's not enough money to pay off the remaining three debts, which is a house, and a student loan. So in year four, the program grows to $91,000 cash. All right, so where's the Achilles heel for this program? And here's where it is. The problem with this is most people that have these kinds of debts are not accustomed to having easy access to large sums of money, ones where there isn't a banker or a financial person telling you don't do it. This is where, for this particular family, this is coming up next year, this particular family is going to have to make a decision. Are they going to stay the course and they're seeing that the program works, or are they going to stop, make a mistake, pull money out, and go do something silly with the money? So when I tell you the Achilles heel of the program, it's this: you have to have discipline. You cannot deviate from the path. You have to stay with the program. Emergencies come up, and that's okay. We've got that covered. Okay, and maybe the emergency in this case for this family is more than whatever $15,000 they have in their emergency fund. Maybe it's more. I don't know. If it is, then they can dip into it if it's a real emergency. But they need not to do that. Need to stay the course. In the fifth year, they're paying off one of the houses. In the sixth year, they're paying off another house. And in the final year, they're paying off their student loans. Now they are debt-free. Now look, this is the effect of compound interest illustrated. I want you to understand how this software works and how we're illustrating. The savings balance column. Remember how I told you we've got that term life program that acts like an umbrella. And as long as the cash value of the program is under that umbrella, we're fine. Okay. What we're seeing here is that actually in year three, loan from savings, and year three, there's money in the savings balance that we could not put into our life insurance program because it would have created an environment where there was more cash than life insurance. So when we look at this column here, this column is illustrated at a 2% gain. Anybody out there know any savings accounts that you can walk into a bank, give them $7,000 and have a 2% gain? I don't know any. So even though it's a little bit of aggressive funding, that's not accurate. This column says it shows a 2% gain. It's not real. The reality is you're going to get a 0.25 or maybe 0.5% gain on that small amount of money. So just as a recommendation, if you're going to do this and you're going to see this kind of illustration come up in the future, then what you need to do is start a second bank immediately. Start one before you, right now. When you take out your primary bank, start a second one, call it a pre-bank. And all that means is that you start a term program that's convertible into one of these private banks. And that way you're set so that you don't have to throw money in a savings account and earn 0.5%. You can throw it right into another bank where you're earning 4% plus a dividend. And you have two banks going at the same time. Great stuff, right? All right. Moving on, paying off the house, paying off the student loans. Now look, this individual is based on a 36-year-old man, this illustration. He told me he wanted to retire at 75. He owns a trucking company, okay? At 75, that's about when he thought he was going to be able to retire with enough money in the bank. I asked him what enough money was. He said, maybe $1 million. So I'm earning, $50,000, $60,000 a year interest. Okay. Using this program, without this program, they were going to be debt-free in 40 years, have 2 houses fully paid off, and have nothing left to show for it in retirement. And he was going to have to work until he was 75 years old. Using this program, he can retire at 55 because he'll have $1.5 million in the bank. Does anybody out there think they can retire if they have $1.5 million sitting in their bank? I could probably do that. The income on $1.5 million would be somewhere between 75 and 100,000, depending on what kind of rate you got. That would be $75,000 a year. I could do that, especially if I don't have any bills. So this is the idea how this program works. It supersizes everything. It allows you to gain compound interest. So the banks, the way they make money is what they call arbitrage. So when the bank lends you money, are they lending their money? Probably not. They lend money from all the people of all the accounts that they have on file. And if they need to lend more than what they have, they'll go borrow money from the Fed at the federal funds rate. And then they'll lend it to you at a higher rate. That's called arbitrage. That's how banks make money. They lend you somebody else's money at a higher rate than they pay to borrow it. Okay? What a debt-free life program does is it turns debt on its head. It gives you positive arbitrage, meaning that most of the time you're going to earn a higher interest rate when you compare the guaranteed interest rate plus the dividend. You're going to earn a higher interest rate on the money that you have in your program than they're going to charge you to borrow against it. Why wouldn't you put every single dollar in here? Well, because you should never put all your eggs in one basket. That's just prudent advice. All right. So what happens if you don't have a mortgage? All right. Will it work for you? Here you go. So this is a student that I worked with same day back in October of 2019. So this person is a master's student. At the time that we did this program for her, she was working as a waitress. This program assumes 2 things. Number 1, that she's never going to graduate from college, which I know she already has. Number 2, that she's never going to make more money than she does right now, which is the ability to afford a $350 a month program. That was the cost of this program. Where she was, student loans, did I mention student loans are evil? Student loans, she was going to be in debt for 40 years. She's 23 at the time. That means at 63 years old, she will be 100% debt free, assuming she never makes more money than she's making now and she never pays more money than she's paying for something like this than she is right this minute, $350 a month. Okay. We got her from 40 years. Oh, by the way, look at that. Did I mention student loans are evil? Her debt is $91,000 of just interest. That's more than her total debt right now. That's because of the effect of student loans. So we took her from 40 years to 9.7. And that's assuming she never overfunds, she never pays any more money into this. She just keeps, she's got a car payment, she's got some vet bills, medical bills, and a bunch of student loans. That's it. Okay. So we got her out of debt 31.3 years sooner than what she was anticipating. That's pretty strong. Eliminated $64,000 of interest. We got rid of about 2/3 of the total amount of interest she was going to pay. But more importantly, where she was, 40 years to debt-free with 0 to show for it, versus where she is with this program, 40 years, certainly debt-free, but $603,000 liquid cash, plus an additional $400,000 life insurance policy fully paid up. I think she's in a lot better place. And again, this is assuming she never finishes. And I know she's finished her bachelor's degree. She's on her master's degree at Cal Poly right now studying marine biology. So her, just like before, we're paying off debts. We're creating the best snowball, getting her to the point where she's debt free pretty quickly. And then this program stops at age 55. At 55, she's no longer funding the program. But look at this. She had $22,000 of the growth that year. That means at age 55, she doesn't have to do anything anymore. She can take a $22,000 per year tax-free income if she wants for the rest of her life, or she can let the thing ride. And when she turns 65, she'll be here. 658,000 growing at 20, almost $30,000 a year. So that is the end of this presentation. What you should do at this point is whoever invited you to watch this video, get back with them. Just spend some time with them. Talk about what your goals are, what your plans are. I would suggest you fill out one of the Symmetry's debt-free life financial analysis forms to show where your debt is, what kind of debt it is, so that whoever your debt-free life expert is can help you create a plan and then move forward with an application to see if you can get qualified for this program through the carriers. All right, I'm gonna go ahead and stop sharing my screen. I've got two folks with me, Alan and Ruth. You guys can go ahead and come on screen if you wouldn't mind. And hello, Miss Ruth. Hello, Mr. Allen. Please unmute yourself. So thanks for coming and joining me today. First question is, for me, do you have any questions?
Yeah, I have a question, Scott.
Sure.
So what about someone who's looking at a shorter time frame? I definitely see the compounding work over the longer time horizon, but just say people like myself, perhaps a little bit more closer to retirement.
Sure.
How can the program work for me?
So I've seen this program work for people up to age 75. Okay, so people that are already retired, because there's different people have different reasons why they're going to do this. Maybe they want to eliminate debt. Maybe they want to create retirement. Maybe they want the death benefit. Maybe they just want a place where they can stash cash and have the cash grow for them. So I've got some people that are on Social Security that don't need the Social Security. So they're taking that money from Social Security, putting it into their debt-free life bank, which is buying more paid-up additions in a larger bank. And they're actually using this to accelerate the purchase of a second home. So there's different reasons why you would use this. It will work for anybody under the age of 75, as long as your debt load isn't too large. Okay, because you have to be able, you have to be able to make your debt service in order to qualify for the program. And otherwise it doesn't make any sense to do it. Does that help you?
Yeah, yes, it does. Thanks.
Okay. Ms. Ruth, you have any questions for me?
No, I appreciate you showing the fact for the people that don't have a mortgage. And then the only other thing is there are some people that are debt free and they're just looking for that retirement. Can you give us a brief overview for that?
Right on. Yeah, those people, then remember how the program works in three phases. You've got maximization, accumulation, and distribution. So the people that don't have any debt, they're starting off in the accumulation phase. They've already eliminated all their debt. They're not going to have the benefit of a snowball, okay? But that means that they've done well with their finances to begin with, which means they may have more money to throw at this. And so, there's some advanced stuff we can talk about later, especially we were talking about people, especially people that are 1099s and don't have any debts really. Those people, yeah, you're going to pay taxes, right? So there's some other options that you have here. But for people that are not out of debt, then starting off in the accumulation phase is great. That means this is working just like a 401 without the tax problems of a 401 or a 403 or any other type of IRA, KEO, SEP, whatever. Okay, so yeah, so definitely if you're in the situation where you're starting one of these programs and you don't have any debt, fantastic. Congratulations, you're ahead of the game. You're ahead of everybody else who still has debt that they're trying to do with. Good job. Does that help you?
Yeah, that's good. Thank you.
Okay. Anything else?
Yeah, hey, Scott. So let's arrest my concerns about the security of my money for the long term, right?
Okay.
So yeah, I'm accustomed to the bank. I've actually worked in the banking industry for a long time.
Okay.
So while they're not the ideal place in terms of return, at least they carry this allure of your money being safe.
Sure. So
forward.
let me ask you this. Do you know any banks that have ever failed?
Yes.
Yeah. Do you think there's at least 60 banks a year that fail in the United States?
That wouldn't surprise me.
Okay. Do you know any insurance companies that have ever failed?
Not that I can think of.
Right. So what we're talking about here is different industries, and they both can do the same thing. If you're looking at the solvency of the banking industry when compared to the insurance industry, insurance companies are the largest institutional investors on the planet. If they have an A rating, that means they are flush with cash. In order to maintain an A rating, they have to have the capacity and have money on hand to pay all of their claims at once if every single one of their insureds dies at the same time. So when you ask about the security of your money, the first thing I would say is, there's a standard investment protocol if you've done investing before, where you're looking at a company and you're looking at if it's a dividend paying company, then the red flag goes up as soon as that dividend goes away, right? That's the alarm bell ringing. Company's not gone yet, but the dividend went away. Okay, let's move, okay? Same deal here. These companies, all three of them that we use, have paid a dividend every year for the 100 years or 100 plus years they've been in business. They have never not paid a dividend. So there's your alarm bell. Okay, so when they don't pay a dividend, it might be, think about moving your money. And that's another thing. When you move money from bank to bank, it can be problematic. With this, there's a tax code for this. So IRS tax code 1035 allows you to move money from one to another. So if you've got a large cash value in your life insurance account and you have a question about whether or not that company is going to be solvent, move it. Do a 1035. It's gone. You have to do it. First thing. Second thing, your money when you invested in a bank is insured for $250,000. That's the FDIC or the the National Association. What's the other one for the credit unions? I can't remember, but they're all insured for about the same amount of money. This has the same insurance. Actually, technically, these companies all co-insure each other. So there may be even more coverage than your just $250,000. But again, I would point to the history of the company and the history of the banking versus the insurance industry. The one thing I like about these three companies that we use is that they've paid a dividend every year since they started, which means they've been through every good president, every bad president, every pandemic, every policing action, every war. They've always paid a dividend. And so I would, look at all the other companies that are out there that pay dividends and ask that same question: have they always done that? And of course, you're going to find a lot of companies in 2008 that had routinely paid dividends but didn't pay them anymore. And from a banking perspective, for me, hands down, this is a much safer place to put the money than it is a bank. But that you have to do your own due diligence on that.
Okay. And what's the turnaround time? Because you liken this to replacing a bank, and one thing a bank does have is accessibility and convenience. So
sure.
How does that work with this
right.
program?
So there's two things that determine how quickly you gain access to funds when you want to pull funds out of your account. The first is how long the money's been in there. So you can't put money in tomorrow and then pull money out of account, pull money again 2 days from now. It's not that fast with an insurance company, okay? But you can realistically expect 5 to 7 business days in most cases. And then the other component of that is how quickly, this is the banking thing, how quickly is the bank going to recognize that you've got a deposit? So I don't know if any of you that are out there, if you've ever deposited a $10,000 check and waited for however long you have to wait for the bank to recognize, where's my money? Either the person that wrote my $10,000 check still has my money, or the bank that I just deposited still has my money. What happened to the 3 or 4 days it takes for, where's the money, right? So the point that I'm making here is it's not a whole lot different than where you're looking at large sum transfers within a bank, or large sum deposits, or large sum crediting of large sum deposits within a bank. Not too far different. You are correct that your access to your money's there. You've got a debit card. You can go get money out at an ATM. This does not work that way. You have to move your money from the insurance down into your checking account or wherever your bank is. So you do have to move the money. It takes 5 to 7 business days, depending. And then also depends on the carrier and how quickly, like I said, your bank is going to recognize the deposit.
So it sounds like then this would be good for maybe my monthly bills, which I know.
Well, yeah. So that's a good idea. And there's a whole lot of math that has to go into that to make sure it's going to work. Because if you start off with that, you have to make sure you're funding it properly. So, this is not, we call it a private bank. It's not a private bank in the sense that you're writing checks and paying bills with it, but you can do dollar cycling. And I've got one client I know who puts $25,000 a month into his private bank, pulls out $16,000 a month to run his business. So in that scenario, he's sequestering $25,000 a month, which means in that 1 year, he's sequestering $300,000. Whereas what he was doing before, by just saving the $9,000 and spending the 16, what he was doing before, he was only sequestering $108,000. So we tripled the amount of money he's saving for retirement using this program. But yes, you can do it that way. You have to do the math, and you need to talk to whoever the professional person is that brought you here to make sure it's going to work.
Okay.
Good question. Thank you. Ruth, you got anything else?
Good. I'm good. I feel like you covered everything well. Thank you.
Okay. Alan, do you have anything else?
No, not at this time.
Okay. Well, thank you both for being with me again. Whoever invited you here, get up with them and look at a DFL program. They're amazing. And I have yet to find a hole with them, except that the discipline thing. When you get access to a lot of money that you haven't had before, it's a scary thing. All right. So we're going to go ahead and sign off.